welcome. You're watching Moneycontrol. I'm Ridhima Bhatnagar at the start of a fresh new week. Good to see all of you back. In Ideas for Profit today, we're talking about Stove Kraft IPO. We're asking, will the pigeon fly high on Bourses? Today, for Ideas for Profit, we focus at Stove Kraft, the kitchen solution provider, which is listing its stock today on the Bourses. It is the third largest player by volume in non-stick cookware with market share. The company has garnered about 11.4% volume share in pressure cookers, 25% and 20.3% volume share in cooktops and freestanding hobs. In the previous fiscal year, more than 86% of the company's revenue came from pressure cooker, non-stick cookware, hobs, glass, cooktops, mixer grinders, rice cookers, electric kettles, toasters, and even the sale of emergency lamps, LED bulbs, ladders, and cloth dryers. Now, the issue opens and closes on January 28th. The IPO consists of fresh issue of 24.7 lakh equity shares with 75% reserved for qualified institutional buyers. In a follow-on offer, the company has also had an offer on sales for 82.5 lakh equity shares. The shares can be bought in a tranche of 38 and its multiples. Stove Kraft plans to raise rupees 413 crores, of which rupees 318 crores is an offer for sale by existing private equity players. Out of the remaining rupees 95 crore, rupees 76 crore would be utilized for repayment of debt and the rest in existing businesses. Let's talk about the financial performance. The stock value Stove Kraft has been historically a loss-making company since 2012 to 2018 and recently turned profitable with 2019 to 2020 margins. The data from the past 12 months shows that the company's EBITDA margin increased by 8.8%. If you look at on FY22 basis, based on our projections of a 12% revenue growth and 8% operating margin, then Stove Kraft is currently trading at about 22 to 24% discount to Hawkins and TTK Prestige. However, the discount for Stove Kraft's multiples is likely to remain given better margin profile and higher return ratio of the peers. And although the company's revenue in the preceding 12 months has been more than that of Hawkins, its peer, the return on equity stood at a negative 92%, which is quite low and might not offer much for the investors. But in the first half of this current financial year, Stove Kraft's margin spiked to 13.7%, mostly driven by strong margin performance that we saw in Q2 of FY21, since majority of Q1 of FY21 was a complete lockdown, which seems as an aberration and may not sustain, especially given the steep increase in raw material prices. If you look at the major control measures, then you have lower advertising and employee cost in the lockdown period may not sustain as revenue growth improves with pickup in the demand. The discount with larger players is expected to remain, and thus the issue leaves no room for value for investors. If you talk about some other risk factors, the company is currently in litigation with its associate company PAPL for its use of its flagship Pigeon brand for manufacture of its products. While the final judgment is awaited, if the court's verdict goes against the company, it would have an adverse impact on the sales and revenue, as the company it won't be able to cash on to its popular Pigeon brand. Overall, we recommend investors to avoid subscribing to its IPOs and instead focus on the peers such as Hawkins and Prestige. Thank you for watching.